Thank you for joining me. I'm Alex, and I want to go over an insurance company today because stocks are still on sale, and insurance companies obviously are very safe and not really seasonally or otherwise affected unless something major happens. But that doesn't happen a lot. So, Allstate is an insurance company, which is kind of why I mentioned that. Current price $109.20, which gives them a market cap of $34.6 billion. So obviously not a small company, and obviously they're all over the TV ads everywhere, on Facebook as well. Dividend yield 1.92% with a payout ratio of 14.6%, which is pretty amazing. Revenue $44.7 billion, up from $39.8, so there's a solid 10% there. Earnings $4.8 billion, up from $2.3 billion, so there's a solid 100% there. PE of 8, forward PE of under 11. Overall, very nice stats there. Total assets $119.9 billion. Total liabilities $94 billion, and that gives them a stockholders' equity of $26 billion, up from $21.3 billion. So obviously things are going in the right direction and fast. And overall, obviously the insurance business hasn't really changed all that much in recent years and is probably not going to change in future years all that much. Allstate is known for their car insurance, where Tesla is trying to enter the market, and that could be a bit of a disruption, but overall I don't think that that's going to be a major risk factor. Obviously also a lot of things are done over the internet now, so that's a minor disruption there as well. I think that Allstate is doing reasonably well there as well. So overall, for risk factors, I don't think there's a whole lot. And what Warren Buffett has said is that the whole idea of float, which means they get paid for services they provide in the future. You prepay your car insurance for the following month, and if something happens that month, then the car insurance will have to pay something. And so insurance companies get a lot of money up front to work with, and interest risk is kind of a problem there. But I'm not sure how long that will last. I'm not sure how long the interest rates are going to be this low, and how long insurance companies can't find decent bonds to put their money in. So that is a bit of a major factor right now, and obviously no one knows how long that'll last, so that might be a fairly major factor years into the future as well. And really no one can predict what happens there. So overall, though, I would say that beyond the interest, nothing really has changed, and nothing is really going to change over the next few years. So solid business, very safe principle here. The payout ratio is amazing. The dividend yield is decent, I would say. The balance sheet is all right. And, the PE is also amazing. Forward PE, obviously not that great, considering that that kind of means that earnings are going down, but 11 is still pretty nice. So overall, I would say that for a dividend investor, this seems like a very good stock right now. For a value investor, this also seems like a very good stock right now. The balance sheet, banks and insurance companies are kind of in the same boat there. A lot of liabilities, a lot of assets. I wouldn't really hold that against them. So for a value investor, I would also say that this is a pretty decent stock. For a growth investor, despite the earnings growth of 100% and the revenue growth of 10%, I really don't think that this is a growth stock, and I don't expect them to have double-digit growth for years into the future. So growth investors are just going to have to find something else, but value and dividend investors are probably doing very well investing in this company. Obviously, always do your own research. And that's it for me for today. If you like this video, make sure to subscribe. I'm coming out with more videos every day before market open. I hope you have a successful day.